Hello again, folks. So as promised, we're going to reach out daily with different updates and strategies and ways that we can add value and enhance communication during this difficult time for markets. And so what I thought would be important is to illustrate 5 different ways that you can actually take advantage of this opportunity. We posted a video yesterday on our social media channels that talked about how when you're in the midst of a storm, it doesn't really appear to be a huge advantage. But when you look forward, backward rather, 2 or 3 years down the line, it's going to be proved to be a remarkable opportunity. So let's just talk about 5 simple ways that you can take advantage of this, this market opportunity. And once again, this is not about timing. I'm not suggesting that this is the exact right time to make any of these types of moves, but let's talk about some of those options. So number 1 is just going to be to actually rebalance your portfolio. So often when we talk to clients and advisors, they just say, okay, we're going to ride it out and we're just, prices will appreciate over time. Well, that's fine, but once again, that's not very opportunistic. And so what we would rather see is if you have a distension in assets, the reason why you bought bonds or gold or US dollars or US treasuries is to actually protect your capital. So when markets actually drop, it's prudent to sell some of those securities and take advantage of it. Because over time, those non-correlated assets are actually going to drop. And honestly, it's just going to be kind of a yo-yo effect and not accomplish much. Number 2 is to consider a principal protected note. Many banks in Canada and the US offer these amazing vehicles, and what they do is they will provide sometimes 100% and often even higher upside on a market, but with a guarantee. What they'll usually do is take the dividend in return and to provide protection so that over a 5, 6, 7 year term, your principal is 100% protected, but you can take the upside. So what that allows someone to do, if they wanted to be a little more aggressive, is to actually step into the market 100%, trying to take advantage of long-term price appreciation, and but then still protecting the downside at maturity. So the one thing to remember though is that up until maturity, it's still going to trade with volatility, which means that if you bought it today and the market dropped 10%, you're going to be down somewhere around those levels, because what it allows you to do is it's still a liquid security. So your guarantee does not kick in until you get to the end of the term. And as we move through these, they're going to be a little bit more aggressive. But the third one would be simply to buy underpriced assets, such as energy is obviously one that's kind of well documented at this time. And by buying these beat up products and beat up asset classes, but also by adding a hedge, you're able to aggressively take advantage of some of these opportunities. The downside of adding a hedge is that very rarely have I ever seen anyone add a hedge that is perfect, so 100% perfect. And what a hedge suggests is that, for an example, let's say that you actually bought you bought a big position in 𝑥EG, which is the Canadian Energy Index. However, your real risk would be further demand fall or volatility in actual markets. And so what you might be able to do is own, say, a 5% position in a leverage volatility index ETF to hedge that position, knowing that if you're successful with 𝑥EG and markets rebound, there's a good chance that you can lose a tremendous amount of capital, if not all of that capital, on the hedge. So what you're doing is you're sacrificing 5% for a hedge in order to get, multiple double-digit return on the upside. But once again, it's hard to time that and make it perfect. And once again, we tend to favor more strategies where you're never going to have a threat of your asset class going to zero. But it is, once again, a pretty good strategy at these levels. The fourth one really is interesting in the sense that it applies leverage. And what that would be is to actually consider an investment loan. If you're making monthly contributions to an RRSP, a tax-free savings account, or even just to a regular investment account in a non-registered format, it's wise to consider, especially with we're at almost record level low interest rates, to actually take out a top-up loan so that you can maximize the price entry at these levels. So what I would mean is, let's say if you're making a $1,000 contribution to your RSP, TFSA, RESP, etc., why not contribute $1,000 worth of loan contribution for a larger amount? So for instance, if you took out a $50,000 investment loan and then made $1,000 payments, but you're able to secure the entry at this level, by the time you pay that loan off, say 4 or 5 years down the road, that $50,000 will grow a lot faster than dollar cost averaging into a market as it rises. Again, a little bit more aggressive and only suitable for the right type of clients, but definitely a consideration at these levels. And one of the coolest ones that we're going to talk about is our last option, which is to have your advisor use their relationships with the Canadian banks and take advantage of the pricing opportunities that are around options today. And what we're able to do in these environments is a trade that we secured today that we're going to execute for our clients going forward is one where we swap out Canadian energy indexes, which we have owned inside our strategies anyways, and we're going to replace them with a multiplier or an accelerator or marathon structured note. So what this is that we go to the bank, we say we want to find what type of opportunity there is for us to have further upside on the Canadian market versus downside. And so what these marathon notes do, the current note is going to provide 2.7 times upside on the Canadian market with a 1-to-1 downside. So what that means is you're going to capture an additional 170% return above what the normal return would be to the upside, but you're still going to have the same 1-to-1 risk on the downside. So within our risk parity strategy and within just traditional portfolios, it is absolutely a no-brainer to swap out the current equity exposure we have on that Canadian equity index and replace it with this without adding any additional risk. So hopefully you found value in those 5 opportunities. There are dozens of different ways that you can play the market, but these are the ones that tend to be more favorable at these junctures just because of a little bit more secure way to play it, less speculation, but these are quite often very impactful. And like I said, when you look back 2 or 3 years from this period, you're going to be thankful if you've executed on one or more of these strategies.